Do you remember back in 2023 when every realtor was saying, date the rate, marry the house? That was absolutely terrible advice, but you can understand why they were saying it. At the time, rates were approaching 8%, and people were confident that in 2 years we'd be back down to 4.5% or 5%. Well, here we are in the middle of 2026, and right now rates are still averaging 6.25%, and there's not really a lot of relief in sight. In today's video, I'm going to cover what's driving interest rates to stay where they are and where experts say we're headed. Hi, I'm Carolyn Bauerschlag, a local real estate agent helping people just like you relocate from all over the country right to our great city. And if you're considering a move to the West Houston area, I would love to add you to our client family. Now, the first major and most obvious driver in why interest rates are still hovering above 6% is, of course, inflation. Now, inflation is something that the Federal Reserve has been trying to curb for the last several years. Now, the Fed has been kind of an easy scapegoat in this whole conversation because the media has made it that way. But what you have to know is that the Federal Reserve is charged with two major things. They're supposed to help keep the economy stable by way of managing inflation and the unemployment market, right? So big picture, the Fed has one major way to influence either of those, and that is to either raise the internal rate of borrowing or to lower it. Now, I don't need to rehash the entire history of the post-COVID recovery era, but what you know is that inflation took off like a rocket sometime in 2022 and 2023. So what the Fed had to do in order to try to curb that was increase their own internal rate of borrowing, which again had an influencing effect on the upward trajectory of mortgages. Now, those mortgage rates hit about 8%, but it wasn't because the Fed set the rate at 8%. There's implicit sort of risk factors that affect the way that mortgage rates go. Now, another sort of pernicious sort of issue here that popped up is that the labor market has also been suffering. Now, what's the main way that the Fed can help the labor market? They can lower their own benchmark rate to help stimulate companies wanting to hire people or do more deals or finance bigger projects. That's supposed to, of course, then grow the labor market. But where we're at right now is that with persistently high inflation on consumer goods, the Fed is concerned that if they continue to lower their own benchmark to help, let's say, the labor market, that it will have an increased effect on overall prices and therefore inflation. Now, big picture, we have other factors besides the Fed that are driving inflation, right? In March of 2026, we have this Iranian crisis that was more or less self-inflicted. And what experts are saying is that the effect of that crisis, where we're still not shipping oil in the amount of 20% of the world production in and out of the strait, is that prices are going to continue to go up. And most have said that in May of 2026, we haven't seen the full effect of that oil sort of shortage. Now, this kind of tags back to, I think in the worst case scenario, what we saw in the 1970s with that oil-related crisis. And my hope is that we don't get to that territory, but it's completely possible and highly likely that inflation will continue to grow. Now, another factor here is that the labor and job reports keep saying things like unemployment is low, but what it's not reporting on is that many people are working multiple jobs in order to get where they need to be financially, which is not exactly a sign of economic health. So yes, unemployment numbers might technically be low, but your average consumer is really having a very hard time. Now, another sort of factor that's not necessarily unemployment, but job hiring rates are also extremely low. And the data that just came out of the government says that we're approaching levels that are as low as the hiring that we saw in 2010, 11, 12, which would have been the 2008 economic crisis, like post-recovery period, right? Like, so none of that is really a positive market signal. So the likelihood of the Fed lowering their own internal benchmark is very low. I would say that in general, what we have seen them do is say the bigger of the two issues is inflation. And as we're looking at prices continuing to go up for every consumer on every possible front, I think that's kind of the number one goal, is to curb that. So just at this last Federal Reserve meeting here in May, they said that they were going to hold steady on their own rate, and the mortgage rates responded negatively to that. The secondary market for mortgage rates went up. Right. So my professional opinion is that we will probably hover above 6 for the remainder of the year. And that's not necessarily bad, but I would say we should lay to rest any idea that it's going to decrease below 5, let's say in the next year or so. Now, the second major factor that's influencing interest rates to be above 6% is going to be economic uncertainty. Now, this kind of goes hand in hand with what I just said about the Fed, but the Fed's not in charge of economic certainty. They're only really in charge of trying to handle unemployment and inflation, right? But the way a consumer feels over time is largely influenced by what's going on in the job market and how much things cost, right? So again, we have very mixed market signals that are going on in the news. And if you just watch the news says the S&P 500 is hitting new highs. The stock market, the Dow Jones Industrial Average is above 50,000, right? And everyone likes to point at that as a way of saying or justifying that the economy is just fine. But the average consumer is suffering, right? And if you look at the actual stock basket of the S&P 500, there's what they call the Magnificent Seven, which are all of your tech stocks, your AI stocks, and they are almost 100% responsible for the gains that you're seeing in the S&P 500. Right. And that means that 493 other stocks that make up the largest corporations in America are suffering. Right. And isn't that really kind of a metaphor for what the rest of us are experiencing? Now, the University of Michigan tracks something called the Consumer Sentiment Index and also the Consumer Confidence Index. And they've been doing this since the 1970s. And just last month in April of 2026, a report came out from the University of Michigan Center that tracks this, that consumer confidence and sentiment is actually at a record low. So that would be a 50-year low, right? So you're not seeing the average person engage in things that say, hey, I feel confident in committing myself to a loan for X period of time because they're not confident in, let's say, their own future income earning capacity, right? Or whether or not their job is going to disappear to AI or whatever the case may be, right? So in order for interest rates to come down, which again are not the Fed's rate, but this sort of secondary rate that is influenced by economic factors, there needs to be higher consumer confidence in the marketplace. And that is something that is not usually solved overnight, but it is something that would be helped by a smoother piece of road for all of us to walk on. Now, that of course tags back to sort of geopolitical issues, right? Like if your average cost of gas is $4 a gallon here in Texas, right? Like that influences all of the inputs for every consumer good that any of us have. Right? It's not just the gas that you put in your car. It's the shipping for the things that you're going to get. It's anything that's coming off of a tanker overseas. It's all of the import tariffs and all of that mess that was created, right? We had this exercise of futility with tariffs for an entire year that really raised the cost of everything on the consumer. So until we get a smooth piece of road to walk on from the administration and on high, I would say that we should expect to see mortgage rates kind of hover at the 6-ish% or slightly higher. Now, a third major factor that's influencing interest rates to be higher than 6% here in 2026 is something that's a little bit sneakier, and that's called the health of the commercial real estate industry, which is maybe not something that you're thinking about in the context of your personal mortgage. But let's think about this for a second. When you get a mortgage, you're going to probably work with a mortgage banker, right? And they're going to originate your loan, and then they package it all up, and then they sell it. And they sell it to someone who's going to hang on to that loan for presumably 30 years, right? And the people that are buying those loans are the major financial institutions like Chase, Citi, Wells Fargo, Bank of America. These are the guys that are going to basically collect your payment for 30 years. Those are the same guys that have been fully leveraged by commercial real estate over the last several decades. A huge portion of their portfolios in real estate is for these giant vacant office buildings that never refilled with tenants after the COVID crisis, right? So they're really kind of sucking wind on real estate in general. So for them to say, yeah, I'm going to accept more real estate as part of my portfolio in the form of your mortgage, it has to be at an interest rate that is at least compelling to them, right? So there's kind of this confounding variable that sticks in underneath all of the rest of this that really has nothing to do with what the Federal Reserve is actually doing. Now, of course, if the Federal Reserve lowered their own cost of borrowing to stimulate business and more people do business and more people then lease office space, yeah, I guess the commercial real estate sector gets better. But this is super complex and it's all interwoven. And so the conversation that I have most frequently with someone in a buyer consultation or in a listing consultation is that they'll say, well, I'm just really confident that interest rates are going to go down. And what I'm trying to illustrate with this conversation here is that it's far more complex than what anyone at the Federal Reserve chooses to do. Now, if all of that just sounds a little bit too depressing, I do have some positive news. At the time of this video, in May of 2026, rates are hovering around 6.25%, which is exactly the rate that was published by the Mortgage Bankers Association, by chief economists across the nation, by the National Association of Realtors, for where they expected rates to be for the entirety of 2026, which means that the smartest people who are in charge of our industry are bang on for what they expected in this economy. Now, it is completely possible that we trend back down towards 6% towards the end of the year. But that would depend on, I would say, less volatility than what we've seen in the last 2 months in our greater marketplace. Now, another piece of positive news is that across the nation, we are seeing every single week more homes go under contract than went under contract in 2025. That, more than anything, to me, is the most positive market signal. That really doesn't have much to do with the interest rate today, but kind of the mood and the sentiment, let's say, of a home buyer. Now, a home buyer might not have the exact same mood as, let's say, the sentiment that I just referenced a couple moments ago, right? Someone who is buying a home maybe has a little bit more cash in their back pocket that they were going to spend anyways. But what we're seeing is at least a little bit more confidence from the person who says, hey, these interest rates aren't good, but they are better than what we saw in 2023, 24, and 25. And they're good enough for me to say, if I want to make a move and get out of this apartment or get out of this rental situation, now is a good enough time to do it. So mood is a hard thing to measure in any market, but most especially in real estate. But pending sales, or the number of people choosing to go under contract being up year over year, is a very positive sign to me. Now, the last piece of positive news that I have for you is local here to Houston. Here in Houston right now, we have about 55,000 homes on the market, which isn't our all-time high, but it's pretty close. And what that means for you as a consumer is that with rates that are as low as they've been since 2023, and with choice as high as it is, you as a buyer have more opportunity to negotiate a great deal for yourself than you've had in several years. Now, I do talk to consumers that often say things like, well, I'm just going to wait for everything to soften further. I just know that as rates go down, there's going to be even more choice for me. And what I like to caution you against that on is to say that anytime we see rates decrease, it is highly correlated with a reduction in the number of available listings as well. And it makes sense, right? As affordability increases, as people can spend a little bit more and not on interest, more people go out and they buy, which then eats up the available inventory. So if you're looking to make the most advantageous move possible, 2026 right now might be the right time to do it. If you're thinking about moving to the West Houston area, I would love to be your realtor. I've helped hundreds of people just like you find their place here in Houston. If you'd like to connect, make sure to check the description below where my contact information is available. And if you found value in this video here today, make sure to click the link below and subscribe because we put content like this out every single week. See you soon.